I think there's a good chance we're about to accelerate higher. And frankly, it scares me. I don't want to see $5,000 gold. I don't want to see $500 silver because that's a measure of the collapse of our financial system.
This bull market in gold started in December I should say it was, I think, December 1989, not
You mentioned 99, but
it
you
was
meant
December 99. So yeah, so we've done a lot of work comparing the gold cycle to previous gold cycles. We believe that if you're going to give me 3 to 5 years, we'll probably get to $6,000 an ounce. So we're in a holding pattern right now.
Silver's bull market is gaining serious traction in 2025. Prices have jumped nearly 25% year-to-date, pushing past $35 an ounce. The rally isn't just speculative noise, it's being driven by real fundamentals: a persistent supply deficit, booming industrial demand, and a surge of interest from retail investors, especially in Asia and North America. Coins, bars, and silver-backed ETFs are seeing steady inflows, signaling this isn't a short-term spike. This year marks the 7th consecutive year that the global silver market is expected to remain in deficit. That tight supply picture is now colliding with geopolitical uncertainty and a weakening dollar, which adds fuel to an already bullish setup. Veteran investor Bob Moriarty, who started buying gold when it was $35 an ounce, sees echoes of past cycles. But this one feels different. He's watching silver closely, especially heading into September. Despite a minor correction since April, the dip has been shallow. He believes there's a real chance things are about to take off. And if silver hits $500 and gold reaches $5,000, it won't just mean significant gains. It'll mean the financial system itself is breaking down. The signs are hard to ignore. The US dollar has dropped over 12% against the euro since January. Tariff retaliation policies have backfired. And with national debt now hitting $37 trillion, while interest payments eat up 20% of federal tax revenues, confidence in America's fiscal position is eroding fast. That's precisely the environment where silver doesn't just rise. It explodes. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I was buying gold at $35 an ounce. I think $3,500 an ounce is an extraordinary price. And there's two things that move the price of the metals. One is geopolitical events, which makes me very uncomfortable. And the other is normal supply and demand. And, the United States stole $300 billion from Russia. The Japanese bond market is in the process of blowing up. We have total corruption in the United States. We have a DNI who is using the word treason with a former American president. Martin Armstrong had said, we've got some scary things. If gold is going up because of supply and demand, which I would be comfortable with, I'm okay. If it's going up because the world's about to collapse, which is a very real alternative, I'm uncomfortable with that. And the reason for it, from the 1st of August through December, is seasonally the strongest period of the year for gold. And interestingly enough, it's different for silver. It's the 1st of September through December that is seasonally the strongest. But if we have been in a correction since April, it's been a very insipid correction. And yes, I think there's a good chance we're about to accelerate higher. And frankly, it scares me. I don't want to see $5,000 gold. I don't want to see $500 silver because that's a measure of the collapse of our financial system. Everyone forgets the way I write my books, my interviews. I encourage people to buy things when they're cheap and sell them when they're dear. And when the price of gold has hit $3,500 an ounce and the price of silver is still hovering in the mid-20s, you've got silver at half of what its high was. I owned silver
Mhm.
in January of 1980. I owned silver in 2011. I called the top in silver to the day. So $3,500 gold is expensive, but $39 silver is still absurdly cheap. And I believe, and I've seen reports that suggest the Chinese listen to me because they're encouraging people to buy silver and to buy platinum. You should put the platinum chart up because it's up 50% in the last 2 months. Well, I don't look at it in those terms. If you go back historically for the last 100 years, the average ratio of silver to gold was 53 ounces of silver to buy 1 ounce of gold. It's been as low as 16 to 1 and as high as 130 to 1. But the average has been 53. So above 53, silver is cheap, and below 53, gold is cheap. But silver to gold is especially cheap now. And certainly you could see literally in the last month or two, somebody has woken up and said, I want to start buying what's cheap. And I'm going to give the Chinese credit. I think they're behind it. The majors are up 50% in the last 2 or 3 months. Now, what happens is the majors move first, and then the mid-tier, and then the lottery ticket. And the majors moved, and they've had a hell of a run, and the mid-tiers moved, and the juniors are starting to move, and you're starting to see moves of 50% in a week. There are so many dirt cheap stocks. The only issue has been raising money. Now, Rick Rule has done a lot of research into it, and he says historically, the ratio of miners to the overall stock market is 3%, and it's less than 0.5% now. So the miners in general have a very bright future, regardless of what the stock market does. And the juniors have explosive 5 to 1, 10 to 1, 50 to 1 potential. I have stocks that I bought for 8.6 cents in January that are 54 cents today. And there's going to be a lot of those. Well, you're going to see more than that. What I'm looking for is a start because the juniors have the most risk, but they also have the most potential in percentage return. And they have started to move. Lots of juniors are doing financings. They're raising money. They're putting money into the ground. And you're going to start seeing explosive results very shortly. The majors are coming out with their earnings this week. I think Newmont had 1.2 billion in earnings. I mean, that's absolutely remarkable. But what's happened, and nobody else talks about this, the majors have consumed their young. And when 30 years ago, the majors had major exploration staff, they've laid all those guys off, and the juniors have been carrying the load, and the majors going to get into a buying frenzy of good companies with good assets. So we're in for a really interesting time. And this is not something that's going to last for 6 months or a year. This is something that's going to go on. It could go on for 10 years. We could have a 20-year crash in the stock market and a 20-year climb in resources, both at the same time. All things change. I'm a big believer in that.
Economist David Rosenberg doesn't see this as a short-lived rally. He calls it a long-term secular bull market for gold, similar to the equity bull run that kicked off in 1982. Given the historical context and current macro setup, he believes gold hitting $6,000 within the next 3 to 5 years is a very real possibility. So far in 2025, gold has surged nearly 30%, driven by geopolitical instability and investor demand for safety. Uncertainty surrounding Donald Trump's aggressive trade moves and ongoing conflicts in Ukraine and the Middle East have all contributed to pushing capital into gold. While prices have mostly consolidated in a tight range over the past few months, This week's gains of around 1% have brought gold to within $100 of its all-time high above $3,500 an ounce set in April. Still, gold isn't moving in a straight line. It slipped after a 3-day rally, as news of a potential trade deal between the US and Japan, and progress in talks with the European Union, helped ease some of the fears driving demand for havens. Prices dropped as much as 1.4% after Trump announced a 15% tariff on Japanese goods, signaling a more rigid stance but also opening the door to future negotiations. The Financial Times report, suggesting a US-EU agreement is close, added more weight to that sentiment. Let's get back to the interview.
Well, I think gold right now, it's entered into a holding pattern. It's had a dramatic rally. You still have deep-pocketed global central banks, and not just the BRICS, that are emerging every month as buyers. They diversify out of U.S. dollars and into bullion. If you want to date the secular bull market in gold, you got to go back to the late 1999. When the Washington Agreement was signed, and all these central banks around the world, led by Europe, that had been dumping gold and moving away from bullion reserves for pretty well all of the 1990s. Well, that ended, and I think that was basically the same time that gold bottomed at $255 an ounce. I mean, we're up 11-fold over that period. The S&P 500 is up 5-fold. Gold is up 11-fold since the secular bull market began. It didn't begin just 5 years ago or 10 years ago. It's a secular bull market. Just as people would date the secular bull market in equity starting in August of 1982, this bull market in gold started in December I should say it was, I think, December of 1989, not...
You mentioned 99, but
it was December 99. So, we've done a lot of work comparing the gold cycle to previous gold cycles. We believe that if you're going to give me 3 to 5 years, we'll probably get to $6,000 an ounce. So we're in a holding pattern right now. I think that the Fed, one of the elements of support, because of course it's priced in U.S. dollars, is that as other central banks are on hold, going into next year, the Fed will be cutting rates. The Fed is far behind the curve. You can't really say that about other central banks around the world. And so as the interest rate differentials converge, the US dollar will come under more downward pressure. And that will be very beneficial for the gold price, alongside all these very favorable fund flow aspects of it, which is coming from the central banks. We can't, after decades of QE, we all know that central banks are very powerful when it comes to influencing asset prices. And until I see evidence that the gold buying program by really about 80% of the central banks around the world are now buying gold, it's not just a couple of central banks, that's going to be a very important development as well. You know, you mentioned before about fiscal policy. I said before, most of the growth in the economy post-COVID came out of the government sector. I mean, the level of spending in the U.S. government is 53% higher today than it was on the eve of COVID, okay? Not to mention $2 trillion of stimulus checks, endless jobless benefits, rent abatements. This economy was really steamrolling along because of the long arm and deep pockets of Uncle Sam. That's over. Fiscal policy for the next decade is going to be moderately contractionary. And I would posit that when I said before how the U.S. is following Japan, Japan did the same thing. Endless fiscal stimulus, but you bloated out the debt ratios with aging population. And the debt ratio, the public sector debt ratio, remember that Rogoff and Reinhardt told us in their masterpiece of about a decade ago that once you cross 90% on the public debt to GDP ratio, you start to impair economic activity. It leads to a stifling in economic activity when we're choking on this much debt. It's a constraint on future aggregate demand. Well, we're at 120%. So the debt ratio as it stands today is actually deflationary. It's contractionary. And then on top of that, what about the aging population? Aging population, as you saw in Japan. Even though you will argue, well, that depletes the workforce, the impact on demand from aging populations is materially stronger than the impact it has on wages and labor supply. So the demographics and the debt are very deflationary. If we're right, if everybody is right on generative AI, then if it's going to boost productivity, by definition, it's going to lower unit costs. So Yeah, I would say that most of the factors, not all, you can check off some boxes on the inflationary side, but I think most of the items I'm looking at are telling me that the future is going to be more of one of deflation and inflation. And don't forget, look at asset prices. And I come back to to where the bond market's trading. Yeah, we've gone back to 5% on the long bond, 4.5% on the 10-year Treasury note. But in the context of an S&P that's at a record high, multiples that have gone, back to 23 on a forward basis, 26 or so, or on a trailing basis, and this is what you got, and you got really a lot of inflation fear at the very same time. So that's why I like the bond market. It's not as if, look, if the bond yields, if we were early in the cycle and we're coming off a prolonged bear market in stocks, if this is like 1982, or if it was 1993, or it was 2003, or it was 2009, and we were coming into an upswing. We had all sorts of cyclical tailwinds in the economy. The stock market was at a low. I wouldn't be sitting here saying, "Go, you want to go extend duration." We're very late stage of the cycle. We don't have interest rates very low. We have interest rates very high. We have an economy that's actually not accelerating. It's decelerating. Like I ask you the question, like, when you average out the Atlanta Fed, the New York Fed, the St. Louis Fed, all their nowcasts, it comes to second quarter growth of 1.9. And what was first quarter GDP? It was negative 0.5. So you average out, people are telling me, look at the stock market, things are booming. But you look at the numbers, real GDP growth is running this year at 0.7%. This time last year, it was 2.3. This time in 2023, the first half of the year was 2.6, 0.7. But you see, I think the folly is that people look at the S&P 500, and so do economists. And they make their assertion on the economy based on what the S&P 500 is doing. But the data are the data, and they're telling you that we are in a stall speed economy right now, and I don't think that's fully priced in. And I know that if it wasn't for all this tariff nonsense, the Fed would be cutting and treasuries would be rallying like crazy. But right now, we've implemented this degree of heightened uncertainty. It seems to have affected long-duration bonds more than it's affected long-duration stocks. But that's because people have this innate inflation fear coming out of the tariff file. And Jay Powell really didn't help things out too much, because I think he must have said at least 3 times in the past month, starting after the FOMC meeting at the podium, that he's expecting a meaningful inflation spike in the next several months. So, that hasn't spooked me, but for a lot of bond investors, they're pretty spooked by that comment. I'm viewing this as a buying opportunity.
Even with the occasional dip, the bigger picture remains intact. Trade friction, global conflict, fiscal uncertainty, and waning trust in central bank policy are all long-term drivers. If those continue to escalate, or even just simmer, gold has plenty of room to run. Momentum in the metals market isn't just holding, it's gaining force. Behind the price charts lies a growing unease with how the system is functioning or failing to do so. Whether it's silver tightening on the back of structural shortages or gold responding to fractured diplomacy and reckless fiscal policy, the message is the same. Investors are bracing for more than volatility, they're preparing for consequences. And with every policy misstep, every diplomatic blunder, metals look less like a hedge and more like a benchmark of truth. Could this accelerating flight to tangible assets be the market's way of signaling that confidence, not just currencies, is what's collapsing? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.